Hey everyone, and welcome to the EcoInvestment update for September 11th, 2016. And very important that I mentioned on this solemn anniversary of 9/11 that it's still something that resonates in my mind and always will for my life. And once again, today it's a day to give prayers and best wishes to the families of those touched by the tragedy, as well as remember those who died, those people in Washington and Pennsylvania and New York who died on this day. You know, we had a little bit of a slap to wake us up from the complacency that we've been under. We've been enjoying this market that's basically gone straight up since that late winter shakeout we had. But now, given Friday's events of almost a 400-point decline, there's some people that are still really starting to wonder if what's really going on with the market, and are we going to continue to go higher? One of the Fed governors came out on Friday and had issued a statement that he believes that it's time for interest rates to start moving higher. Now, a lot of people have said that over the last couple months. The vice chairman, Mr. Fisher, came out and mentioned that he thought rates should probably start to be ticking up. So we can't say it's new news. The reality is, though, that there could be something more of a market correction taking place, meaning that people are trying to, some of the big money is trying to shake some people out of the market, get some weak holders, get some cheap stocks, and maybe drill the market higher here. It's known to happen whenever you have a market that's having trouble making headway like this one has for the last month. It's not unusual to shake the tree real hard at some point in time and then hope to get rid of the weak holders of stock, and then the market's in a stronger technical position to move higher because the selling has already been done. Now, are interest rates going to move higher? They had a substantial move last week up to the 1.66% level. We were around 1.57, 1.58, up to 1.66. In percentage terms, a pretty big kind of move. And it could be the beginning of movements up here, of rates moving higher, but you have to balance that off against the fact that the economic data that's being released is not too great. We had that rather tepid employment report for August. In addition, we have a service sector that's just barely, and I do mean imperceptibly, even expanding right now, just holding steady. And remember, we're supposed to be in a service-based economy. And also remember, we're 8 years, supposedly 5, 6, 7, 8 years into an economic recovery. Well, it sure doesn't feel like it. So could there be another incentive behind what the Fed's doing, trying to start pushing rates higher? Well, suppose we go off the cliff again in the economy and the Fed has no wiggle room. They have no room to lower rates anymore because they're already on the floor. Well, in a scenario like that, the Fed could look pretty inept. They could look useless. They wouldn't have any function anymore. Their only function is really to raise and lower interest rates and set reserve requirements for banks. But absent that, there's nothing else really for them to do. And I think what they're trying to do, the Fed is trying to get that interest rates moving up a little bit so that they can follow them, not lead them, but appear to be following interest rates. And they want to claw back some of these cuts that they made, the 0.25%, the 0.25%, the 0.25%. They want to raise rates so when the next downturn comes, they can look like they're cutting rates again, and at least it buys them time. You and I both know, though, that the Federal Reserve is painted into an ugly corner. If they raise rates too much, they crush a very weak economic recovery. If they don't raise rates, they further damage banks, insurance companies, savers. It just gets uglier and uglier and uglier. Now, if you're looking at things from the perspective of what does history say? Well, history says when you're in a bubble, which we're arguably still in, we could be popping it, we may not. But if you're in a bubble, the reality is you need something to pop that bubble. And that pop is going to be substantially higher interest rates. And I don't see them anywhere on the horizon. So for the time being, I'm sticking with my guns. I don't want to see a sustained downtrend. If we break below that 17,500 level, I'll be closing out my positions, having had a pretty decent run up from that level. So hang in there, enjoy. As you can see behind me, I don't know if you can see over on the ocean there, we're out at the Pacific Ocean, Missy, Jen, and myself. Some guy fell asleep at the wheel out there 4 miles offshore, and well, when he woke up, he was beached here on the Pacific, on the beach here in Sonoma County. It's a darn good thing that he didn't fall asleep about 5 miles up the coast, or he would have smashed his boat on all the rocks up there. Anyway, we'll see you in a week or two. Thanks so much for being along, everybody, and remember, today's a day to remember. Thanks.